Welcome to the Big Brain Podcast. I'm Larry Cermak, president of The Block, and I'm joined by my co-host, Namik, CSO of MegaETH. Today, we have a special guest to talk about the crash of October 10th. We have Evgeny Gaevoy, the CEO and co-founder of Wintermute. Evgeny, welcome.
Yeah, everyone.
They say money never sleeps, except when markets close at 4 p.m. and on weekends. That's opportunity lost to lend, to grow, to make moves. But now everything has changed. A first-of-its-kind trade. U.S. Treasuries financed with digital dollars. Immediate, after hours. Live on Canton, entirely on-chain, privately transacted. Liquidity unlocked, whatever the time of day or night. Instant financing, settled atomically. Turning 24/7 collateral mobility into a reality. Trusted by the world's leading institutions and the next generation of builders. Real assets, real utility.
Why don't we just kick off really quickly? Obviously, what happened on the October 10th was kind of shocking to a lot of people. Can you walk us a little bit through what actually happened, what you think kicked off some of these events, and also how Wintermute positioned itself in an event like this?
Yeah, I would say, what happened is, a bit far away from knowing exactly what happened. It's pretty clear that the start was with another set of Trump news, which basically caused pretty big liquidation event. Well, the biggest ever liquidation event across the space, which was a very unusual day for, obviously for a lot of people, but for market makers as well. So it was not business as usual during those this hour when it all unraveled for sure. And I think it was very different, and we're gonna touch upon ADL, and we're gonna touch upon about what was actually different this time compared to other crashes or other busy events. But it was just very unusual, very challenging day for a lot of people.
So there was about $19 billion of liquidations that were sort of publicly known to public. Obviously, Binance also doesn't really report exact data, right? I think they're limited to one liquidation event per 1 second. So probably it's much larger. I would guess 25, 30 billion minimum. That's probably at least 5 times as large as the second largest liquidity event that happened before. Why do you think that was? Was it just because there was so much leverage in the system at the time? Or was it just because some key infrastructure was failing so badly that, market makers like you guys just couldn't step in to stop some of those cascades?
I think it's a combination. We definitely have not just more leverage, we have a lot more tokens to play with, a lot of more perpetuals on those tokens, and quite a few pretty big platforms to trade those perpetuals. If you're talking about, 2-4 years ago, we just didn't have that many perpetuals with such big open interest and such big potential for basically go down. I think in terms of general sophistication of the market, in a good way, it is somehow, well, it's basically better or more sophisticated than it used to be, but it also kind of led to a lot of issues. I think once we know who exactly blew up or who exactly suffered, we'll know more. But my big suspicion that a lot of people who blew up or who suffered a lot of losses were running long short strategies, for example. So they might be, I don't know, short Bitcoin, long some shitcoin, something. And they thought they were relatively safe, but they were not because of beautiful EDL mechanics. And that's on one hand. On the other hand, to answer, it was also very challenging in terms of the market conditions. And because generally what happens when the market crash is things just stop working everywhere. And especially as a market maker, basically what you end up doing is, let's say you buy on Binance and sell on Coinbase, you end up having pretty big stablecoin inventory on Coinbase. You end up having all kinds of tokens on Binance, but you cannot move them over. because for both of them, basically all their withdrawals will be completely flooded. Like it will be impossible to move things over. So when people are saying, oh, market makers went out of the market because they were like, I don't know, scared of the conditions, they didn't want to provide liquidity, most of the time we simply couldn't, because we couldn't show bids in one place, we couldn't show offers in the other place, because we just couldn't move inventory around. And that was happening across centralized exchanges. It was on Hyperliquid, it was on DeFi, like it was everywhere. And that was one of the more challenging things about it, because you just couldn't send stuff across.
So there's a couple interesting points. First, you've mentioned this thing called ADL, which I would bet for 90% of CT participants and perp traders, it was the first time finding out this weekend. But you've also mentioned like this inability to be active in multiple different exchanges to the extent that these market makers traditionally were. So from my point of view, yes, this Trump news came in, and there was a mixture of, obviously someone was over levered and blew up, but I'm hearing a lot of people saying that Binance was ill prepared for this event, right? And that coupled with these ADLs on Hyperliquid and obviously something like Lighter going down created a bit of a suboptimal environment. So could you maybe walk us through potentially what an ADL is, right? And how it impacted the vast majority of traders over this weekend? And can you explain the frustrations or like maybe agitations of not being able to have the same trading experiences between exchanges and what that would result in terms of inefficient markets?
So starting with ADL, effectively it's supposed to be a matter of last resort. So like generally, okay, you enter in the perp position, like at some point you run out of margin, you're going to get liquidated. So that's kind of normal. And usually the way exchanges do it, they just liquidate you on their own platform. If they cannot do it, they're supposed to, well, basically the insurance fund is supposed to take a hit. And the ADL was like never invoked for, I don't know, years, I think, like on most of the platforms. Simply because like it was never that drastic, but ADL is supposed to be the matter of like the very, very last resort. And basically what it does is it looks and, okay, there are always like let's say it's a market crash like we had in the 10s. So we had a lot of people who were long, they're getting liquidated. If you liquidate them through the book, it basically would happen, I don't know, at a zero price. It would just make the whole platform massively insolvent, and all the short people obviously will be very rich. So what they're trying to do is they're trying to cancel out some of the shorts, and basically effectively like so by canceling a short, you effectively create an artificial long to cancel out the liquidated longs. So it's kind of like sort of elegant way to solve this whole situation. And like on paper, it should be working fine as long as it's orderly. But in this case, it was, I think on most venues, it was rather disorderly because primarily like, okay, what is the price you are creating this ADL at? Like what is the sort of like price you're going to be canceling those short positions effectively? And that I think is where we will see a lot of, well, basically challenges from a lot of trading firms to a lot of exchanges in the coming days and maybe weeks. Because I can tell you, like for us, for example, some of the ADL fills we got were very strange. So it just didn't make sense for us. And it basically creates like for a market maker, it creates basically like there are two situations where it creates problems. Like first of all, majority of market makers run short perp, long spot exposure. It basically allows them to be delta neutral on one hand, on the other hand, basically having a spot exposure to market maker on centralized exchanges, on DeFi, or whatever. Basically, it just gives you inventory in the underlying spot. So if you are, and you basically do it and you assume, okay, I'm basically delta flat, okay, if market ticks down, I'm also fine because I'm short perpetuals. But if you get ADL'd, you lose your short and you're suddenly long spot only, and this spot is also ticking down and you need to somehow hedge it. And you cannot do it on perpetual anymore because everyone getting ADL, so you need to sell spot to hedge yourself. And it's just not a really nice sight because suddenly you're like long out of the blue and you don't really expect it. I do suspect that's why a lot of market makers actually lost money on the 10s. And we did lose money that way as well. Like there were like some perpetual positions where we got ADL like on Binance and some other platforms. And like, okay, it's fine to get ADL if you can hedge, but also like our challenge was like sometimes you'd get ADL to a completely ridiculous price. It just didn't make any sense. Like the most ridiculous case, I think it was, I don't know, price we got ADL was, let's say $1 and sorry, we got ADL at $5 and the thing was called trading at $1. So, and then you just don't even have a chance to hedge basically anywhere. So you just stuck with the loss right away. I mean, you can hold it, but hoping that it will come back up, but that's not usually what market makers do.
My understanding is that Ethena, for example, has a contract with a few exchanges where it doesn't even allow them to get ADL'd. Is that not something that's possible to get done for market makers or like large accounts like you guys have, where it would just give you more protection? Or like, why would Ethena get special treatment and then market makers don't?
Well, first of all, I'm not 100% sure Asina actually gets the special treatment. Also, quite important to note, like Asina is effectively only doing like Bitcoin and Ethereum.
Right.
So
Less
those
common.
like will much
Yeah.
less subject to ADLs on all those platforms. So like those ADLs are vastly more applicable for all kinds of alts, meme coins, like whatever. So it's not really applicable to Asina. Like, would we like the same protection? Yeah, we absolutely would like. If this protection exists, we would absolutely love it. Does it make sense for exchanges to give it to a lot of people? Not necessarily. And I think if they do, they should be very public about it. Because, like a lot of people on Twitter mentioned, it's if this happens, you need to know what part of open interest is effectively like non-ADLable, whatever the verb is. Because otherwise it's just not gonna like it's just really bad market structure. So, like, I would be open, obviously, to get this treatment, but I think it should be ultimately very transparent and very like much better done if that's the case. But maybe it's not. Maybe it's just all conspiracy theories. And I think
So
another thing that like nobody actually talks about, and that used to be that actually is still a feature on some exchanges, like for example Coinbase and Kraken have it, and it used to be the case on exchange that we all used to love called FTX, is a BLP program, where effectively they allowed market makers to take over the positions that would be liquidated. So basically bypassing this insurance fund, bypassing everything, basically allowing people to allow market makers who are perfectly positioned to take this risk. Those BLP programs are notably absent in basically all the big venues that faced major liquidations. And I do think it would help quite a bit if those BLP programs would be set.
So an ADL is like a last resort for an exchange. But Hyperliquid actually made money with their vault over the weekend. So how does that work?
It's a very good question. And also, not just Hyperliquid, but basically pretty much all major exchanges. Like, we haven't seen big drawdowns from any insurance funds whatsoever. But again, we probably see some of the ADL people being compensated, hopefully, from the insurance fund, but who knows? But like, I would expect the insurance fund to kick in first before ADL would come into effect. Yes. And for Hyperliquid, yeah, like for Hyperliquid, it's interesting. Like it's all, I think somebody raised as well. Like it's a very interesting contention between now, basically between Hyperliquid users and Hyperliquid token holders, because Hyperliquid token holders obviously want the compensation to not happen and the fund to go up, and Hyperliquid users actually want to trade safely. So that's one thing that Hyperliquid will need to be solving going further, I think.
There's one theory kind of circulating on Twitter, but just in general, that the reason why this was much worse than the previous liquidations, or part of the reason, was that now we have this huge exchange, which is like top 3 in open interest, Hyperliquid, which has a lot of very transparent things like liquidation points, even effectively most things you would normally not see on Binance or OKX or Bybit are now transparently visible on Hyperliquid. So it could be maybe a little bit easy to estimate, hey, like we need to get here to hit this liquidation and therefore force some of this liquidation cascade. Obviously sounds simpler than it probably is, but do you think that's something that actually contributes to, seeing so many of these liquidations roll in and some of these assets fall by, 90% or more?
I think if the only exchange in the world would be Hyperliquid, I think it would be a lot more reason to have this kind of, I don't know, conspiracy or not theory, is that it was somebody actually literally targeting Hyperliquid and basically causing this cascade. Given that like a lot of this open interest is still on basically exchanges where you don't really see the liquidation points, I think it's less likely. So I think it's more interesting point. Okay, is Hyperliquid the future? Like, can Hyperliquid be the only exchange in the world where it's like everyone's seeing these liquidation points and this functioning like this? I'm probably in a camp which thinks that they should sort something about the privacy of everyone's liquidations at the end of the day. It's a bit too much information basically. And like one way to solve it is, well, to make it more private. Another way to solve it is potentially introduce again what none of the exchanges have for whatever reason. Well, I mean, I kind of understand why, but still, it would be nice to introduce circuit breakers, like especially for some of the tokens that are not supposed to. Like I know you see in the de facto like 60 cents. Like okay, maybe you should just hold trading or like put it into auction mode or something, but it should not be allowed to depack so much. Like a lot of those things should not be allowed to to fall like double digit percentage points. And TradFi solved it long time ago. Pretty much every TradFi exchange has a circuit breaker. It doesn't allow your whatever the stock, future commodity or whatever to fall a lot. Like there will be circuit breaker in place to prevent that, and either halting trading or putting it into auction mode or combination of the two. But yeah, none of the crypto exchanges have it, and it was always a mystery to me why nobody bothered, because that would have protected a lot of people. Yeah.
But would that actually help if, for example, just one exchange does it? Let's say Coinbase does it, but Binance doesn't, and a lot of the price discovery happens on Binance. Would that be sufficient? Because then you still have Binance, you still have on-chain markets, still trading, right? Like there's in some venues are just not possible to stop, especially the on-chain venues. Would that be sufficient if we're talking about like let's say Binance does this next week? Would that be good enough, or do you think like most exchanges would have to follow this for it to be actually effective?
So it's a trade-off, right? It's a trade-off of, okay, do you want to liquidate all the longs because prices went down 50%? Or do you want to make sure that, well, you stay solvent because you think, yeah, prices actually, well, basically, yeah, do you think prices actually didn't dip 50% and it's just a flat crash and it will go back up? Or do you think it's an actual crash and I want to, yeah, basically maintain the solvency of my exchange? And I think Hyperliquid and Lighter actually did it like completely two different ways on DeFi side. And yeah, centralized exchanges also can choose one or another. Like obviously in our like nobody like if Bitcoin falls, let's say not even 50%, but 20% on your exchange, like I think as an exchange you can take a safe bet that it's you should invoke a circuit breaker and it doesn't actually fall 20%. It must be like some kind of weird thing happening. If some shitcoin falls 50%, okay, that can totally happen. So like you can totally introduce the circuit breakers, at least in instruments where it makes sense.
So would you describe, like, you said Lighter and Hyperliquid had two different approaches. Would you describe Lighter as almost taking the circuit breaker approach, even if it was accidental? Because, you couldn't trade.
Well, basically, people who had position on Lighter, they were better off as a result. People who wanted to trade on Lighter during the time were worse off as a result.
Yeah.
So yeah, it's a trade-off ultimately. It's a trade-off where you protect people with like longer term positions from being wiped out for no good reason. Because okay, we covered market makers who are short perpetuals and long spot. So there's another group of traders who also probably would react quite badly. It's basically long short people. So yeah, like people who are like short Bitcoin, long, I don't know, Fartcoin, for example, like they probably got wrecked the most because they thought they were delta neutral, but first they got ADL on their Bitcoin and then they got liquidated on their Fartcoin and they got ended up with nothing.
There was this rumor a while ago that exchanges did this on purpose, right? They would go down and effectively cause the circuit breaker while claiming it's just an outage. Like one example I remember was when BitMEX went down during the COVID crash. There was a lot of speculation that they did it because they thought otherwise the price would literally go down 99%. Do you think that's something that actually was happening at the time and they just didn't call it a circuit breaker, or was it just that the infrastructure was not ready? And honestly, and then the follow-up question to that is like, why does this still happen? Why does Binance and some of these exchanges still go down despite like understanding that these huge spurs of demand will happen from multiple cases before?
So I tend to think that the simplest explanation is a more likely one. So, and to me, the simple explanation is infrastructure for vast majority of centralized exchanges sucks. Like it's nowhere near the level of, I don't know, CME or NYSE or Nasdaq. It's just not on the same level. And there are like historical reasons for this that I understand, but like I don't think anyone is moving to, I don't know, Nasdaq technology anytime soon, for example. Um, and because the technology is so bad, yeah, they fail quite often, and that's kind of obvious. To me, that's more likely explanation than some kind of big conspiracy theory of exchanges going down to wipe out some retail and make money in the insurance fund. Because I think at the end of the day, it's just a very risky game to play. Okay, for most exchanges, it's much better, and market makers, by the way, it's much better to have retail gambling for days and weeks and years than to wipe them out like every year, once every year, because then they're just gone. And not only they are gone, a lot of people are scared to come back because they see them being wiped and they just go away.
I remember during the Luna crash, which was like sort of similar, not as drastic, but pretty bad as well. Um, it took like 2 or 3 weeks to find out that Three Arrows was insolvent, right? It took a relatively long time. Now you have liquidations that were probably 5, if not 10 times larger than back then. And there's some speculation here and there that market makers were affected, the trading firms were affected, that whoever else was affected, lending firms. We haven't found out about anyone really like being wiped out fully or just blowing up completely, right? We found out about a few trading firms that lost some money, but there isn't like anyone's body hasn't floated up yet. Like, do you think that still happens based on just how much damage there was in terms of open interest and liquidations?
I think the world was like my perception is the world was a lot more intertwined in 2022. So like Three Arrows affected a lot of things directly because they're just running massive long positions. And I think the question you need to ask yourself is, okay, if that market maker goes down, if a market maker goes bankrupt, like what actually happens? Like what would be affected? Because at the end of the day, okay, like everyone is afraid, okay, what is going to be the contagion scenario? And the contagion scenario for market maker, like if they are really desperate, like we all remember what Alameda did, like when Alameda started going bankrupt, they like just started selling stuff on DeFi, which was very visible and it was very weird. So, but I think ultimately with market maker, if market maker, but let's just take like, okay, I'm here, so let's say Wintermute goes bankrupt. We can talk about like probability of that and what
We
we have
got
in
the
place
snippet,
to
Larry. That's all we need.
so what we do to prevent it, but like ultimately, okay, let's say we like okay, somehow all our equity is wiped. So what do we have? Like we have a bunch of I don't know loans with Wildcat, we have like a bunch of other uncollateralized loans, so all those go to zero. We have a bunch of loans we have with protocols, so like I don't know, also like market making agreements we have. So like we still have those loans as well. So those like okay, we can go and like sell it all, I guess, if you're bankrupt, to try to recoup some money for some investors, or I don't know, run away. And we have basically counterparties that we are settling with who might have the margin with us. So basically, like you're looking at the contagion you're looking at is primarily, I would say, the protocols this particular market maker market makes for, and the counterparties that hold margin with them. And this margin can be like Bitcoin or Ethereum, for example. So maybe they will sell those, which is very limited to effectively. I think primarily it's limited to like those market making tokens, really. So if you take example of not Wintermute, but like some smaller market makers that might be wiped out, which is possible, you are looking at very small contagion of like maybe they will market make for some protocols, so maybe they will actually start actually selling those tokens. But maybe not, because it's also probably not going to save them that much money, to be honest, because like you usually cannot like get rid of that many tokens that easily, and it will be very visible. So basically, to come back to that, I think contagion is pretty limited compared to 2022, where it was like a lot of intertwining between like, okay, Three Arrows led to Genesis, and Genesis was borrowing from, I don't know, Gemini, and like it was like all intertwined, and like a lot of bankruptcies resulting from this. Like nowadays, I think it will be much more benign.
Generally, like these super high volatility events are good for market makers, but you mentioned that probably for some of them it might have not been good. So is there any like learning that you have from this event that Wintermute has in terms of like what to do next time? Is there like something you're adjusting based on what just happened? Maybe the ADL strategy or like better, faster hedging when something like this happens? Is there something like that you guys are going to be talking about and trying to integrate going forward?
I think that's one of the more challenging bits about those kind of events. Like they literally happen like once a year, once every 2 years. You can learn lots from it, but spending resources to optimize for the next event like this just doesn't make any sense for most people. So I think a lot of market makers, they basically like, I'm pretty sure like a lot of market makers just went out of the market because the conditions were just not applicable to how their systems operate. Like we were in the market, but we were in the market in a very limited capacity because of the inventory issues that I explained before. So it was very challenging because of that. It was not unusual, like we've seen it before, but it was a lot more challenging than usual. And if you add like ADL on top, it's even more challenging. So yeah, I guess like one thing that we learned, okay, we need to handle those ADL events better and try. Also, like in our case, we picked them up pretty quickly because our systems just picked the changed our open interest, yeah, pretty fast. Well, basically in our positions pretty fast. So okay, you just suddenly long and you're trying to sell and you get like 500 ADL emails from Binance, and okay, you just need to manage that. But learnings wise, like that's it, like you can build a perfect system that will trade it perfectly, but it might not be worth it for the other 364 days a year where you completely don't need it. So it's not obvious, I would say. Like we literally had a meeting today about discussing okay what we can change and certain things, okay, like we know how we can do better on our side. Like for example, like we had a lot of I don't like we had like a lot of internal breakers on the pricing side. We just went out like every minute, which we might like do less aggressively in those like next time we do those events. But most of it was pretty straightforward. Like I think we're quite happy how we handled it. Okay, we had some losses on ADLs. We made some gains because the markets were like amazing in terms of volatility. So it more than canceled out. So we are happy with how we performed. Could we have done better? Yeah, we could have always done better. It was also really annoying, like with all the FUD, of course, but it's also kind of understandable. Like we had to talk to a lot of our counterparties. We had to talk to a lot of our protocols that we are market making for, basically reassuring them. Some of them even like showing like, okay, what our inventory was in different exchanges. Like it's annoying, but it's also kind of, yeah, such is life. Yeah, it's totally fine for people to be paranoid on those kind of events.
So, what do you see the next um, few months looking like? Right? It's absolutely shocking to like visualize how large of a liquidation this was compared to these other moments. I remember we had a few episodes ago. Larry and I asked guests what was the moment in crypto that you felt like this might all be over, and a lot of people would reference like FTX, right, Luna, these big black swan events. Well, we just had one that eclipsed all of those. And I mean, I think none of us necessarily feel like the world's actually ending. Just a lot of people lost a lot of money. So what do you see the next couple of months looking like?
My intuition is that it primarily like, okay, basically the question is, okay, what is it going to affect the bid for crypto in general? And I think it will affect the bid for anything outside of majors effectively. Because like where those liquidations happened, it was all like all kinds of altcoins. And we have a lot more altcoins, meme coins, and other stuff to play with compared to, I don't know, 4 years ago. People will just have to be a lot more selective with a lot less money to invest as well. So I think the bid for altcoins is probably going to suffer as a result. That being said, new retailers getting born every day. So it's like eventually it will come back. But I think, okay, in terms of like short to mid impact, intuition would be, yeah, it's just the beat for alts. Like, yeah, I don't think we're gonna have like a massive altcoin season in terms of.
Would you say that it was almost like impressive how well both ETH and Bitcoin and even Solana to some extent have held up during this period? Like we've had some tokens like Cosmos went down 99.9%. And the worst for Bitcoin and ETH, I think, was like 15% or something. It was not drastic at all. Like we've seen something much, much worse before. Is that just a sign of like maturity of the market and maturity of these assets and liquidity in these assets, or what do you kind of think that was caused by?
Yeah, I think Bitcoin at this stage is just institutional grade asset. That's it. Like it has ETFs, it has MicroStrategy, it has like so many things. Well, CME futures, whatever. Ethereum is pretty close to it, and I think Solana is also relatively close to it. So I think I wouldn't be worried about Bitcoin having like a massive flash crash, like almost ever, save for some really weird events, maybe like happening because of digital asset treasuries, but maybe not. Like I really cannot see like what can possibly, well, outside of I don't know, maybe some quantum bullshit saying can really touch Bitcoin at this stage. Yeah, so like well, I think it's pretty positive that like quite some assets are making it to be like properly like not scary to hold. And I feel like the more of those ETFs we'll see, the more of like TradFi access we'll see, like the more like basically the less likely those assets can like dip too much. So which effectively means you can be long with a lot more leverage on them. That's basically the implication. So I think we'll also see like a lot more leverage being attracted by like BTC and ETH and like Solana later on.
One more thing I wanted to ask you, Evgeny, is that you guys are primarily London-based. You also have some international offices, but I would guess a lot of your trading team and people you kind of need on deck is in London. I think this happened like really late London time, almost overnight as well, or not late, but it happened in the evening. How do you guys deal with these situations when, for example, the traders you would need to be trading are sleeping? Do you have people in different countries that step in immediately? How much of your trading is now done automatically versus like human intervention? How do you deal with like these things happening when, maybe at really bad times for you guys?
Yeah, I mean, it's thanks to Trump. Like we are pretty used to those events happening exactly on the weekends or on Friday late for us. So it was not like I mean, it was a shocker, obviously, but like we were prepared for those kind of events. And like usually the way, like, yeah, it's not the greatest work-life balance for traders in general, like in any trading firm, to be honest. So like usually the way we work, okay, we have London office and Singapore office, and Singapore people take over like something like 10, 11 p.m. London time. And that's when London people start, well, more or less chilling. So this move started happening before that. So nobody had time to start chilling yet. So yeah, we just had a very busy night.
I spoke with someone at a different market making fund or trading shop, and they said they have these devices that wake them up during the night if something like really bad happens. And I think it's mostly because they're just not as large as you guys. You guys have the luxury of like having Singapore offices and other people who take over. Is that something you do as well, like yourself, for someone who's like really important at the company, where let's say price moves by more than 15% on an asset where you wouldn't expect it, would you wake yourself up, or are you now like sufficiently distributed that you would just sleep through it like a baby?
Basically, I am to be woken up when like something really bad happens, basically when we lose a lot of money. So actually that night I was sleeping pretty well. I woke up to a lot of like messages to on Twitter and stuff to like saying, "Oh, are you guys dead?" So I had to like deal with that around 8 a.m. in the morning. But no, I slept pretty well. Like our team didn't sleep pretty well, but I had a basically it's a luxury of running a big successful prop trading firm with like many traders that yeah you can afford to sleep and yeah deal with whatever issues next day.
So if you were woken up like at like 3 a.m., you know that you're probably
Oh yeah,
fucked, like something
yeah,
really bad happened.
yes.
So that hasn't happened yet. Like you haven't like woken up to total chaos yet.
So no, I mean we had a hack, right? Like back in
Oh,
2022.
right.
So that was yeah one thing when I got a call and I knew okay that's probably that.
And overall, in terms of like impact that you've seen outside of decentralized venues, maybe in DeFi and in things that are more permissionless, like was there any learning for you guys? You're not that active on the DeFi side, but you also have some operations there. Was there something that broke, or was there something that like surprised you? One example, at least for me, was like that Aave, for example, seemed to do quite well during this event. Like there was not a lot of really large liquidations and seemed to be quite robust compared to like what we've seen before in DeFi. We didn't see anything like super bad happen on the DeFi side. Did you guys experience anything that like was surprising or something that really broke on chain?
With the small corrections that we actually relatively active on DeFi, it was basically mirroring the issues that we had on CeFi side, which is basically inventory. So again, like things on DeFi, from what I remember, like from what I understand, like they were a bit like things were trained over, but we just ran out of inventory. So we basically sold everything we could on DeFi. We bought everything on Binance, but we couldn't really send anything from Binance to DeFi. So we just had to like wait for inventory to come back. Like one thing you can, like one way to deal with it is potentially to start like borrowing assets from Aave, uh, which comes with its own risk because you can in turn get liquidated theoretically. Another way is to try to, okay, like depending how long this thing goes, is you can try to like trade in and out. Like, okay, you can basically price your USDC on DeFi differently to USDC on Binance, but it also has its own challenges. So, and like I said, it's like this stuff happens like once a year. Do you build something special for it, or do you not? Like we've seen most of our competitors on DeFi basically not trading this during this event because I'm pretty sure like yeah, probably their circuit breakers just went off. Um, yeah, I don't know. Like I'm relatively happy how we did. Like I wish we made more money, but yeah, we just ran out of inventory.
One of the last questions that I have, Wintermute is probably kind of almost like sacrificial goat on crypto Twitter, right? Like almost anything that goes wrong, Wintermute is always to blame. Someone finds a few transactions of you guys depositing a few hundred million on Binance and telling everyone that you're dumping. Well, obviously or not, it's a delta neutral trade or some sort of arbitrage. Do you still get bothered by that? Like you guys obviously don't really rely on what retail people think or what Twitter thinks. You mostly, I'm guessing, just care about your LPs and the market making deals that you have. But how do you deal with that? Like, are you fine with it at this point? Is that something that you're trying to like turn around with time? Is that even something that can be turned around?
I honestly don't think it is, and I think basically the like how I made peace with my with it in my head is I'm generally like very sad when people are stupid. Like it's kind of it's I don't know, it's like a sad thing for me to like make peace with that people are just posting completely idiotic things and like drawing completely wrong conclusions from a bunch of not connected facts or data. But I guess how I make peace with it is like, okay, the people who are effectively saying, oh, Wintermute posted 700 million on Binance in 24 hours. They might be like covering for something without actually looking what we withdrew from Binance, which would be roughly the same amount. Um, it's basically the same people who gamble on altcoins, and it's basically the same people that we make money from. So it's kind of, yeah, it's a weird, I don't know, biological relationship, I guess, that we make money from them being stupid and they being stupid on crypto Twitter to kind of like make for it, which again, sad, but if they were smart, I don't think we would see that much trading activities. That's, I guess, how I see it.
So in summary, you're saying that your haters end up being your exit liquidity, so you're fine with it.
Not the exact liquidity, but yeah, those haters are just yeah, they basically go into this casino, keep coming to this casino, and being very unhappy that they keep going to this casino. And yeah, what can I say?
Namik, any more question for you?
Yeah, so I guess like the only thing that I'm curious is like the role of a market maker in my mind, at least, is right to find like an efficient market and help an asset figure out what it's worth. I think that's probably why market makers get such a bad reputation, right? Because if assets are just going down and to the right, you accuse the market maker of being at fault. And the largest market maker that at least most people know is Wintermute. So you guys, as Larry said, like you are kind of the sacrifice for all market makers. Everyone just blames you. And I don't necessarily think it's going to change either. So pretty tough.
Yeah, no, I mean, it's kind of like two-pronged, right? Like on one hand, okay, let's say Binance price goes down and we start selling on DeFi, and everyone posts like those pictures of like, oh, Wintermute is selling, 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 selling. But we're just reacting to somebody selling on Binance. But people only see Wintermute, it is what it is. On the other hand, like, okay, we have a lot of OTC counterparties. Again, like some of them come to us and say, like, I want to sell 1 million of this shit token. And we're like, okay, sure, like, we'll do it for you. And we start selling, and people are again, Wintermute is selling some shitcoin. They're crashing our price. And again, we are not the source. Like, we're always in the middle between the actual seller and the market. Some people understand it, some people don't understand it. It is what it is. It counts as territory.
Do you ever foresee expanding past market making? I'm not sure we've gone through like the full suite of what Wintermute does. You mentioned OTC. Yeah, do you guys go, long net, like on your own side? Do you guys have a team that does like any sort of prop trading? Or yeah, what else do you guys do outside of market making?
No, generally, yeah, like it's another big misconception. Like generally, Wintermute is long, pretty much always. We have been long since 2022, for better or worse. Well, even earlier than that. Like on one hand, we have a venture arm, so like that's naturally on a lot of like venture investments. A lot of them are just locked tokens. On the other hand, we just have Bitcoin, Ethereum, Hyperliquid, a bunch of other things just on our balance sheet.
No Sol? You guys aren't Sol bulls?
We have Sol as well, yes. We got some locked ones like a couple of years ago when there was that amazing transaction. So like we have a lot of the stuff. So us crashing the market is just very stupid because we directly just harm our portfolio, which is not great. So yeah, but also like on risk side, yeah, because it's also quite important to mention, like we are never like leveraged long. Like basically our longs are always like we have this rule where we always loan not more than 25% of our net equity. So okay, if everything goes like if all crypto goes down tomorrow, okay, we're gonna be like 25% worse compared to like we are now, but we're gonna be perfectly like not bankrupt. And on top of that, we also have a bunch of other risk things. Like, for example, we don't park more than 35% of our net equity, not balance sheet, but net equity on any given platform. So again, like if Binance goes down tomorrow, and like FTX style, we will lose 35% of our equity. We'll still be fine. That's why we survived FTX. That's why we survived the hacks. That's why we will survive anything but like complete destruction of like, I don't know, whole like 3 or 4 exchanges, so like 3 or 4 biggest exchanges, then okay, then we'll probably go bankrupt. But that's like relatively unlikely. So we have like those pretty big. So again, like when people are saying, "Oh, you post 700 million on Binance," yeah, that's like it's actually we're like quite a bit above like our limits for that particular exchange as well. So it just doesn't make sense.
Last question for you, Evgeny, before we wrap up. Do you regret taking a lot of the investments into Wintermute and now having to pay out huge dividends to them? Do you wish that you could do it with less capital, or do you think it was beneficial for you guys and kind of help you get where you are?
I think like pretty much all investments were definitely beneficial except for Series B that we did back in 2020, end of 2020. But then again, like we did get like close with a lot of investors. Like Pantera invested into us, and they had been a really great partner for us. And then, so I don't know. I'm a lot more philosophical about this. Like I think it's totally fine to be diluted. It's totally fine to, I don't know, grow a bit faster. Like and yeah, you never know. Like I think it's much like this idea that you should have like I don't know 95% of your business and like own all of it. I don't know. I'm not behind it. It's totally fine to give some to investors. It definitely should be fine to give a lot to employees. Like employees are pretty big shareholders of Wintermute as well, for example. We're still trying to find more ways for them to be even more of that. Yeah, I'd much rather have like whatever 30% of really big pies and 95% of a smaller one.
Well, with that, Evgeny, thank you so much for coming on and talking to us about the crash and giving us a little bit of an insight of how market makers work. So thanks so much for coming on.
Right, great.